after all, I mean, I want to point out that one of the chief objections to investing in emerging markets was always that the politics were rather dicey, and now I think that we've achieved equality with the developed world.
Well, I'm a New York City-based lifelong Democrat, so my world is completely over. But coming back to emerging markets and building on what Arvind said, we came into this year, and I fully agree with some of these themes of the things that had improved in emerging markets, but seeing a world in which the drivers on the liquid market side of things of emerging market asset prices were increasingly domestic and decreasingly global. So you had to understand domestic policy, domestic politics, domestic flow of capital on a country-by-country basis. And I think that is still true. None of that has changed. What the election did was it adds in a layer of potential additional winners and losers into this equation. And the way the market is currently thinking about it is sort of, infrastructure equals commodity prices are good, equals commodity exporters will do well. Trade is more Asia, and if it tends to be negative, that's going to be problematic there. Who knows? I think the market has leapt ahead in terms of its assumptions of the good parts of the mooted policy, assuming the bad parts won't show up, and assuming it'll all get implemented smoothly. And I think that's the second element to me, which is you add this layer of potential winners and losers based on U.S. policy, and then I think now, not just because of the U.S., but because of politics elsewhere, including in some emerging markets, you have to add this element of thinking through the potential for big political surprise and action that you would never have thought possible 3 weeks ago. You think about Taiwan and China and this discussion going on and what kind of response that could engender. So I think that's the other thing. In terms of private investing, there's not that much of it that is done with a pure export view in emerging markets anymore. A lot of it is domestically driven. Again, that is not going to change.
Well, I mean, the one question that raises for me, Nick, is this: you look at the domestic factors that are important for investing, and you find at the company level, the sector level, what's interesting, and then you allocate your capital, and then you're just blown away by some global event that either sends money rushing in or money rushing out, and your valuations are at the mercy of factors that are completely beyond the control of the company or the government or the sector regulator or whatever it might be. I mean, how do EM investors deal with that, and is that something that has any prospect of changing?
Look, I think EM investors, they're buying cheaper, right?
Right.
That's how they're dealing with it, right? They're buying in at cheaper prices and expecting that to compensate. You'll never find, I think, an EM private investing house that manages the FX in any kind of aggressive, systematic way, because in most countries that's just too expensive to do. So the answer is buy cheap, help the companies grow, and manage your way through the process well.
Does that mean, I think all of us here are kind of long-term investors, aren't we?
Right. So I mean, I have the benefit from coming from a private equity / infrastructure background, so we're not so impacted by the ephemeral sort of things that bring liquidity in and out of the market. So the question is can you find a value dislocation that makes it worthwhile going there? Like, I always like to say, with our Denim Power, we're not emerging market guys just trying to bring people emerging market exposure. We're power geeks, and we're kind of boring people. And so we have a value dislocation that we can go there and 75% of our revenues are US dollar euro. How often can you get that in emerging markets? We can go into a dysfunctional country like Brazil, but 20 some odd years ago, they had a moment of lucidity and they put together a power network that works. You've got Petrobras and other people who've had these major defaults. They own 3 of the 64 distribution companies that buy your electricity. They have any problems? They're not prepaying revenues like they're supposed to. They just weed them out. There's been no massive default there in the 21 years since it's been up and running. You can get IFC and US OPIC in your deals in Africa. The project default rate in Africa is 1/3 of what the power project default rate is in the United States. So you can get these value dislocations if you're willing to dig in and do the work, but we have the benefit of 10-year lockup private equity. Proof's in the pudding when you put these projects together and you bring in exits to people. That's what gets investors to come into it and give it root. But it's not the first thing they think about doing when they get up in the morning. I want to get into Ghana or Cote d'Ivoire and build a combined cycle gas power plant, or do wind in Brazil. Yet more and more, look at 18% of infrastructure spending over the next 15 years is going to be in emerging market power. So it's really hard for people to ignore that for too long.
And what's your investor base then? I mean, how do you?
It's the large institutional investors that and some family offices and foundations and things like that. And they tend to come at it from either. It's all. I mean, when you're out there fundraising, I've learned it's all bucketology. What bucket? It can be infrastructure, it can be private equity, it can be real assets, it can be special situations. What is it that they look at? And you're trying to appeal to the various buckets, but it's long-term money.
I had a fascinating meeting with a bunch of Dutch pension funds a little while ago, and among the great things they said, they were all complaining about their boards, because their boards are making those allocations, they're putting the money in those buckets with no knowledge or experience of actually investing money throughout their careers. So, I mean, do you find, your EM tends to be this little adjunct to the portfolio that a big institutional investor will think about. Frontier, even further out on a limb. How do you persuade people that they need to commit money to a 3 to 5 year horizon when it's an asset class that they're just not familiar with?
Yeah, I guess the tricky bit about investing in frontier and emerging markets is about the mismatch between the opportunity set and the liquidity that investors require. And when I go into a meeting with global allocators and we explain to them what's the opportunity set and why they should be investing in frontier and the smaller emerging markets, it's always about what you mentioned. So structural gaps in infrastructure, change in consumption habits, higher urbanization rates, the formation of the middle income class, which is consuming more and differently, and how you can monetize that. And also, it's all about the change in the regulatory environment, the role of government. Very often, you are investing in healthcare because the private sector is taking over the role of the public sector. And these are typically themes that will play out over the next 10, 15 years. And then you spend half of the meeting talking exactly about what we're talking about, which is last 3 months flows.
Right.
That's what is in their mind. And this is where you need to make an allocation and an investment which matches the investment horizon of your themes. You can't be thinking healthcare, education, infrastructure. There are gaps that will be filled in the next 10, 15 years and thinking, oh, what's going to happen to my portfolio next month if interest rates rise by 25 bips in the US, or if Trump is elected, etc. So this is the big work we have to do in terms of educating institutional investors globally investing in frontier emerging market, because the investment opportunity is definitely there, returns are there, but they need to bridge this gap of liquidity. And I would say that US investors have a maturity in terms of investing in emerging and frontier market, which is higher than what I have seen in Europe, where there's a lot of focus on liquidity. So if you go with a quarterly fund in the US, they will tell you that's too liquid. You should have 2 years lockup. You should be having much lower liquidity. And you come to Europe, they want you to have daily liquidity, right. Investing in 15 years investment opportunities.
Yeah.
So I
You're fixed income. Go on. I mean, that's.
I was going to say that I'm the lucky one to some extent on this panel, because I happen to be in an asset class that is perhaps the most mean reverting.
Right.
In comparison with those that might, fundamentally languish for much longer periods of time. But having said that, I have to say that when I started off in the business in the 90s, EM debt very much behaved like equity, and it had the tendency to spiral not only down but out. In other words, you'd get all the way to default because of the lack of investment funding sources. And so if capital left, it often left for too long, and then you had to restructure the debt. So that's changed fundamentally in the last 3 decades. So now I think the majority of EM debt, whether local or hard, is actually investment grade. But investor attitudes to EM debt are as yet unchanged. I think they still regard it as neither fish nor fowl. In other words, it sits in the uncomfortable spot between developed rates and equities. And because it occupies that hybrid position, it doesn't receive a lot of capital. And I think, yes?
But wasn't this one of the things that happened this year, that you had debt starting to behave, people were buying debt for capital appreciation, and they're buying equities for the dividends, and everything was turned on its head.
So it's the strange world we live in, with negative interest rates and with an excess of capital that has prompted the search for yield. And then when the energy crisis occurred and commodity prices went off, then it created a price appreciation potential for emerging markets in the early February timeframe, from which it recovered. But I'm making a slightly broader point, which is that there's a risk premium in emerging market debt, which comes from being a slightly neglected asset class. In other words, that premium has to get rich enough to attract new capital, and it just lags a little bit behind the amount of capital that it needs. That's actually a fundamentally very good thing, because it's less likely to get inundated by capital that will then end up defaulting. So in other words, if you pour too much money into investments and infrastructure, et cetera, which are not ready, or where there's not the rest of the elements that you need in order to make good returns, that's usually a bad investment proposition. But lending to these countries broadens that out a lot. And most of them are either BB or BBB ratings-wise. So they're just in the middle there, and that allows for a lot of ups and downs. And it allows, Mike Pettit wrote a book 20 years ago called The Volatility Machine. Mm-hmm. And that, unfortunately, remains true for this asset class. So it does have a lot of volatility, but together with that comes a higher risk premium and better returns longer term.
But surely a lot of capital has been chasing after that, hasn't it? We've seen this kind of transference from what used to be the problem with emerging market debt, was that it was sovereign, and that the government, and you were worried about current account deficits and currencies and so on. Now it's become very much the big explosion has been in corporate debt.
And domestic.
Exactly, and domestic local currency debt.
Yes.
Isn't there a worry? The kind of worry we hear from people, at the newspaper, that there is a serious worry about this. Not just that, the currency mismatch and so on, which I think is perhaps often overplayed as a worry, but that you've had a transference from the sovereign balance sheet onto the private sector balance sheet, and a huge ramp up, not just in bond issuance in local and foreign currency, but also in domestic bank lending to the corporate sector. Well, what you end up with in the end, if that goes on, is a sovereign crisis, because it all ends back up on the sovereign balance sheet in the end when it starts going wrong. These are the kind of things, the kind of fears that people express to us quite often. Is that not?
I believe that those fears are legitimate. There's always a grain of truth to them, but they are more. They're somewhat overblown, and the reason I think that is because the rise in debt around the world is so huge, and especially if you look at where most of that debt has accumulated, it's in the developed economies. Mm-hmm. So developed economies are much more levered up debt-wise than emerging ones, sure, even with the run-up in recent years of emerging corporate debt. So what that really ensures is a very long period of very low interest rates. So the primary way in which these balance sheets can become untenable is if they become unserviceable from a coupon perspective. And the fact that rates are going to remain range-bound, I'm not saying that they can't go up. They certainly have gone up, and I think that they're now going to be in a somewhat higher range. But you will never see the 70s and the 80s and even the early 90s types of rates again. And because you won't see those, I don't believe that you should think about leverage ratios in quite the same way as you've done in the past. I think you should think about debt service ratios as they would be under more realistic interest rate scenarios. And when you do that, you'd find that the majority of the concern is misplaced. That's not to say, though, that there aren't plenty of companies that have borrowed too much, either in dollars or in local currency. And many of them will, in fact, have issues. But by careful selection of those companies, there's a ton of very good debt out there. And the sovereign debt, in particular, I think is especially good.
Let me just extend that question to you, because another thing that gets suggested to us is that the emerging markets, they're growing. They are growing more than developed markets at the moment, and it looks as though, at least for some point during this year, the differential in growth between the two was expanding, so that's great. But they're still growing from a pretty low base. If you look at historical EM growth, it's quite low in the range. It's not moving up at any great pace. Doesn't that create a problem that you just by failing to grow the denominator, your leverage accelerates and that stores up problems?
Look, I think the growth differential is back. It had collapsed to almost zero at a certain point in the last couple of years, and when that growth differential, at least in virtually all the consensus projections, is widening back out, that has tended to be a very good precursor towards asset performance in emerging markets. But I just want to build on the topic you were talking before. I think for liquid market investing in emerging markets, you have to think through it across each asset class, each set of the structural underpinnings of that asset class, and what the intermediation in that asset class looks like. So equities is an under-supported structurally asset class in emerging markets because it's part of global equity mandates by and large. Mm-hmm. It is a well-intermediated asset class because there are futures exchanges on most equity markets, and it is a wildly volatile asset class because you have to incorporate FX into the equation. Sovereign hard currency bonds have had an enormous benefit of mean reversion, cyclical interest rates going down for 20 years, and credit compression as the sovereigns have gotten more creditworthy. There are huge numbers of dedicated MB mandates out there that support that asset class, and it is a relatively liquid asset class. In terms of intermediation, corporate bonds in emerging markets, particularly hard currency corporate bonds, are, in my opinion, a big accident waiting to happen because the volumes are so large, the issuance is so badly followed from a research point of view. There are very few dedicated EM corporate bond mandates out there, which means it's mostly crossover money. And the intermediation capital put to work in that marketplace, like in investment grade and high yield, has come down by 80% over the last few years against an explosion in issuance that you referenced of 5x over those few years in very concentrated, very large pools of capital, like what Arvind is managing. So when either interest rates go up or creditworthiness is called into question, these investment managers will be pushing the elephant out through a keyhole. Mm-hmm. And I think that is a problem or an opportunity. And local currency debt is increasingly supported by local currency pension fund reform, insurance reform, what have you, which helps, but to the extent you get crossover investing, that money does flow in and out. And FX has the benefit of non-traditional economic actors, e.g. trade flows, strategic flows, and central bank flows affecting FX and those marketplaces, and is by far the most liquid of the liquid marketplaces. So I think you really need to think through structure of the market, nature of the beast in terms of the asset, and how the intermediation works as you think through your prospects of investing on the liquid end of emerging markets.
So again, I think there's a distinction between the public markets and the private markets, and that's really exacerbated by the fact that there's such little public market trading that's going on in the EM. But you have the opportunity far more often when you're talking about bricks and mortar in emerging markets to either go in unlevered or with very highly structured project finance with significantly lower default ratios to transact. And your growth is actually working in your favor. I mean, over 80% of population is emerging market. 75% of the GDP growth that's going to happen over the next 15 years is emerging market. 93% of the urbanization that's going to happen, which drives all this growth, are emerging markets. So if you're playing in the right field privately, you can tap into that growth, and you don't have to lever yourself up to the hilt. So, a lot of international and U.S. investors think, wow, I got to get, dollars deployed. I want to go to a safe haven. I'm going to go put my money into the United States. Indiana sounds pretty good. Toll road, right? It sounded really good, except in order to compete, because 95% of developed market capital stays in developed markets when 80+% of the population's outside. So you're beating your head against a wall to put the dollars in there. You're over-levering, you're making second-hand beta assumptions. You're not bidding to P50, you're bidding to P10. There's a little world called bankruptcy, and it happens in Indiana as well. Or London City Airport here transacting at 37 times EBITDA. Melbourne Port, 25 times EBITDA. That's what people are chasing, and those are highly levered. So again, let's not throw the baby out with the bathwater. Yes, when you look at the public markets, you have all that data, but you have a significant opportunity on the private side to invest without concerning yourself with leverage. Quite often, not just in my field of energy, but many others, not having necessarily the same sort of FX exposure as well. So, I just want to take a little bit of a contrary thing, but I know this gentleman really wants to ask a question.
I just wanted to ask if the panelists can tell what are the top 2 countries they like and what are the worst 2, so that we can put context on.
I was going to throw that at them in a minute. That's not
that would help us
Yeah.
what you like and what you don't.
We can talk about that, but can I just say a word about the emerging market corporates? Because I agree very much with Nick that I think that if you had to pick a spot in EM which has perhaps attracted too much capital in the last several years, it would be that. And I think that, for that reason, the beta returns of EM corporates are somewhat suspect at this point. I think that there's not very good indices to support them. And therefore, I think that anyone investing in emerging market corporate debt should be careful to make sure that the majority of the returns are active. Now, if you make that stipulation, there's a ton of very good companies, either because they're world leaders in what they do, or because they actually have a very strong government sponsorship. The rest of the crowd is a really mixed bag. And I think that it's going to take quite a long time for that market to mature and come into its own.
And as Nick said, there is this vast universe of EM corporate debt with almost zero coverage. So let's just take that question there before we come on to the next one. I was going to say 3, but I'll have 2 since the questioner said 2. It doesn't have to be a country, but give us a company or a sector or an asset or a country where you think 2017 is going to be a good year.
Within my investment universe, which is, again, the smaller emerging market in the frontier space, I think the country that can do extremely well in 2017 is the one mentioned earlier, which is Egypt.
Okay.
Why Egypt? It's coming from an extremely low base, so the economy is not in good shape. But what we're seeing is a lot of reform at the macro level. The flotation of the currency is a very positive event. And it's also a very bold step that the country has taken not to support the Egyptian pound anymore and cut subsidies, work on the fiscal situation. And it's a country that is competitive in many sectors. And today, you are unlocking all of the potential of the country. It's also a country which is completely underinvested. If you look at the foreign participation to the market is very close to 0.
Okay, one other, quickly. Well, let's do one each, and then we'll come back. Come on.
So 1. Okay, so I'll just take one that's way off to the sidelight. I like Vietnam a lot.
That was going to be my second, by the way.
You can share it.
Do you want me to give it back? I've got more. So I like Vietnam because we're getting paid in the local currency under a power purchase agreement for hydro that we're developing there. But it has a capacity element that's tied to how much does it cost to construct a new power plant in US dollars. And it has an energy element that is what does it cost to get fuel inbound in US dollars. So if the dong goes short, goes down, I'm actually short the dong because I do have some local costs. So I've got a totally contrarian sort of FX play. And I like the fact that we're getting decent returns there, and I like the fact that buyers from all over the world, so strategics, as I always think about independent power companies, utilities, they're setting up shop there to start buying things.
So can I offer a local currency and a hard currency? Because we have very different views on countries based on what the asset is. So on the hard currency side, I'm going to say it's Russia. It's not the strongest return country, but it's certainly going to have one of the best information ratios, we think. I think Russia is a beneficiary of Trump coming to power, but quite apart from that, the recent reflation in oil and the stabilization of oil prices, together with very good macro management, have left the country, I think, in pretty good shape. They didn't waste their reserves trying to defend their currency. And I think they're in an extremely good position. If you look at the external, that's really tiny fraction of their reserves, and yet they continue to command a reasonable risk premium. On the local currency side, I'm going to pick Indonesia. Because of the anti-Asia sentiment that swept markets in the wake of the Trump victory, a lot of them have gotten killed. But Indonesia has gotten killed, undeservedly, I think. And both the currency as well as the local yields have leapt up. And I think that the reason for that is straightforward. Indonesia depends to too great an extent on a foreign investor base to buy its local bonds. But it's not so large that it would bankrupt the country. It's large enough to create a lot of volatility. And historically, that's always been an extremely good entry point for domestic debt in Indo. It's it's not very liquid, so it takes some time to collect. But I think that's probably the country I would pick as being the best opportunity in local.
Nick?
I would say I love Argentina and I like Brazil.
Okay.
Kind of across the board. Argentina radically underinvested in country for 15 years, which has an absolute A policy team. So you get in cheap, very good policy team, I think huge amounts of upside. Brazil, not nearly as clear that it's the A team, but it's getting better, and it was much more blown out, and it's much bigger. On the negatives, Turkey for kind of obvious reasons, and I would say China, I'm not particularly negative on, but I'm kind of ambivalent about. And I think in this issue of where could you get a politically motivated market surprise, China would be one of them.
Yeah, so I promised a question over here.
Sorry.
Ian Rice, Family Office. What are your thoughts on the current currency crisis in India and its impact on the economy, short and medium term?
I can take that if you like. So the demonetization, the abrupt demonetization caught everyone by surprise, as indeed it should have done, because you can't actually conduct an operation of that sort, which is intended to clean up the underground economy if you announce it well in advance and plan it with lots of people involved. And the withdrawal of such a large percentage of the monetary base even for a relatively short period of time is bound to be quite negative and disruptive for the economy. And that's indeed what it's proven to be. However, perhaps smaller than people thought. So actually at this point, 12-odd trillion of the 15-odd trillion of the notes have been, that were demonetized have been redeposited into the system. That's a larger fraction than people had expected. I think in the longer run, provided, and this is an important provision, that the Indian government doesn't allow the same thing to happen with the new notes or with other forms of transactions outside of the official system that were happening in the past with cash. I believe that this would be quite a positive in the medium term, and therefore one would expect a dip in growth next year, but I think that growth would then come back into the 7+% in 2018 and beyond.
You kind of wonder if it was worth it with the amount of validation, don't you? That maybe there wasn't that much hidden away that was still. But anyway, so we have a question over here, please. And then, sorry, could we have the microphone over here for the next question?
Coming from the world of politics and not of business, we are talking very much about rule of law, or the lack of rule of law and corruption, wherever we move. So I'm a little surprised that none of you has mentioned that problem yet, and whether this is not one of the main criteria which is then giving you a hint whether you are on the right side or not.
We had it. We did. I think Nick just mentioned it in Turkey and China. I mean, it certainly is around. But go ahead.
I'll take it. I mean, you have to have eyes wide open on it. But I will tell you, if you do, there's only two places in my career where I've gotten involved with the government helping to root out corruption. New Jersey, where I helped their anti-fraud office put the Hudson County executive guy in, and state of Florida, where I testified on behalf of the FBI. So I'm not to say that it doesn't happen, and you have to be careful of it, but we're fortunate you're flying a UK-US banner. People know, how you're going to do business, and so you're more looking to the left and the right and doing a lot of work. That said, there's certain no-fly zones. I mean, I wouldn't bother, for me personally, going to Angola, because I just know I'll never get to the other side of a deal that I would do. So there's places like that, you have to look for it. But it's closer than you think.
I think a lot of people tell us, for example, that there are some assets you can buy and others that you can't. So you wouldn't want to own Russia, there's a shortage of Russian bonds. I mean, they're going up they're being sought after just for scarcity value. So the capital appreciation is there, but you wouldn't necessarily want to buy a business in Russia and have it expropriated. In Turkey, I think maybe people exaggerate the risk of expropriation because you probably have to be a Gulenist to have your business taken away from you. But nevertheless, it does, and people are saying this, several people are saying this to me only recently, that it does make people stop and pause and think long and hard before they commit themselves. Did anybody else want to? Egypt, how's the rule of law?
No, I think the point is so key. Rule of law is so key in investing in emerging and frontier markets, and it's not just the rule of law. Also, the quality of regulation and the clarity over the rules when you're investing is extremely important. And if you look at Egypt, for instance, what made most foreign investors desert the market is exactly what you just mentioned, because from a liquidity perspective of your investment, you had a lot of uncertainty. You didn't know how you can repatriate your capital, and that's what meant that everybody left the country. And that's what we're talking about. So today, we have a clear framework. We have a clear strategy that has been presented to investors. We know how you can get your money in. You know what the policy is going to look like over the next 3-5 years, and that's what makes us much more keen investing in the country. So that's definitely always at the back of our mind when we're investing in EM and frontier market. There's no doubt that the way you need to think of it as well is not where you stand, because the reason these markets are underdeveloped because the rule of law is not that strong. Let's not think otherwise, but it's more about the momentum. Is it improving? Are we going in the right direction or not? So if you thought of the static picture today, there are many countries you wouldn't invest in emerging and frontier markets, but you need to think more from the derivative of it and how it is moving, if it's moving in the right direction or not, and that's where you can capture a lot of beta and alpha, in fact, in these markets.
I'm sorry, just one other point. On the private side, there are prophylactics that you can put around this, where you can have New York Convention apply, you can have international arbitration where it's agreed enforcement, you can bring multilaterals into your deals. So there's a lot of bells and whistles you can do to get rule of law in a country that's enforced through multilaterals and others very effectively.
Yeah, and you can import it and export it. You can have Russian disputes settled in the UK, and you can have New York law applying to bonds from everywhere. Sorry, Ivan.
I was going to say that that when it comes to sovereign debt, whether it's domestic or external, this is an area which is perhaps it's still affected by the considerations of corruption and of poor governance, but it is less so than many other types of investments. That said, of course, we've had Argentina, we've had Russia, and just in the last couple of years, we've had Brazil enveloped by political scandals. I don't mean to minimize it. However, what I want to point out there is that there are two mitigants, for debt investors that we employ. The first one is that Sovereign debt is an extremely difficult thing to revive once you've messed it up. As the Greeks know, and as the Argentinians found out, it took 10 years before they were able to come back into the markets. And even after that, they had a court case in New York, which went bad on them, and through an interpretation of law. Essentially, they were stuck without capital markets access for it. So from the issuer's point of view, it's an extremely painful thing to have bad governance result in a default, and then you're simply shut out. So it's because it's not in the country's best interest. You need a perverse situation. You need people who are running the country who are actually not doing things in the country's best interest. And that can happen from time to time, but it's rarer than you think. The second element is the risk premium. So there is a price at which, investors, even with very bad governance, can still make strong returns. And you should never forget that in EM.
Question over here.
Thank you, Jonathan. My name is Aubrey Ruby. I'm with Africa Expert Network. My question is for Hedy and Scott and Nick. Knowing that you can't really talk about returns because your lawyers won't let you and the structure of the fund, but I want to dig into the question of, are they there in EM and frontier markets in particular? I focus on Africa, and one of the challenges of raising a fund on Africa is that the funds that have gone before us have returned poorly. And if there really are the compelling returns that we all sell in the 20% IRR time level, then why isn't there more institutional capital coming from the United States when a lot of pension funds and others are basically insolvent by 2020, desperate for returns? And so there's like a squaring the circle here that's the problem. And I find that most of the institutional investors believe that EM is where the growth is going to be in the medium term, but they just disagree on when the medium term begins. So there's a timing issue. So I'd love to hear your response on whether the returns are actually there.
Yeah, I mean, you're right. We can't talk about returns. All I can tell you they're great. So
High five, man.
So I think that if you have an approach which is a medium to long-term approach, and if you're focusing on what we talked about earlier and not generic exposure to emerging markets, which I think doesn't make sense. If you're investing in emerging markets, you're not investing in GDP growth, and you shouldn't be looking at it that way. If you're investing in emerging market, and frontier market, you typically are looking for filling these structural gaps and the secular theme that we talked about. And these are medium to long-term themes. And the attractiveness of frontier markets as well is the fact they are under-researched. So you need to be investing with specialists, boutique firms that are on the ground, that understand these markets, have a network of relationship, understand the business, speak the language, and can source these opportunities that give you the alpha that you want. I don't believe in ETFs in emerging market. I don't believe in access trades. You don't generate any specific alpha, in my opinion, in the medium and long term.
But even private funds like Carlyle has reorganized their entire EM team saying listen, these returns weren't there. So I just want to push back a little bit on that, because even on the private equity side, the question is, are they there? And I couldn't agree more with specialists, because that's the kind of firm I run. So
Right.
Thanks for the ad right there, but I appreciate it. Maybe Scott can speak. I know you get some institutional capital.
Yeah, I mean, we're large pension plans, we're large family offices, we're endowment funds, foundations, and the like. So, and I think our returns have been there. And I started off with the concept that we're power geeks, so we can go anywhere. If I wanted to invest in landfill gas in New Jersey, God bless me, I could do that. I find it's much more profitable to go to places where the fundamentals support you, where you're in this intersection, and I don't think this is just power, I think this goes beyond that. You're at this intersection where people are underserved, and what they're getting is overpriced. So you can provide them something that costs less that they really want to have, and because you're coming in greenfield, you actually can make good money doing that. So your underlying build to hold returns are much higher than you're going to get in those other places. And we've demonstrated that, that you can do that and that you can clip that at the end, even in a place like South Africa where the rand went down 32% by the time we invested in wind and solar and when we exited, but the inflation protection that was implicit in the PPAs got us back, a good chunk of that between exits. So I think yes, but one of my problems is, and you may not like this answer, Aubrey, I'm sorry, but one of my problems is that when someone says, I'm just going to do X, and I've had people report to me they're just going to do X, they find X to do. And it may be good stuff, maybe bad stuff, maybe this, maybe that, but that's what they're doing. They're going out and getting you exposure to X. I'd rather have the luxury to say, I'm going to try to get the best value dislocations I can get wherever I'm going to get. And then you can hold me to the mark to see whether or not emerging markets were better or not, and I think I can prove they are.
Yeah,
Or, in my case, we invest in Europe, right?
Well, and certainly, look, the pan-EM anything, of course, a manager loves that, and I think it makes the most sense. It's just a lot of the clients have decided it's their job to choose the region and the timing. I founded the Emerging Market Traders Association back in '88, which helped to bring transparency and liquidity to the debt markets. And in my firm, we've grown the private investing side a lot over the last 4 or 5 years. So now I'm on the board of Emerging Market Private Equity Association. And it's given me a chance to sort of take a look at the industry. And my answer to your question on the private side is, it's a very young industry. And it's tiered just wrong. You have a bunch of small guys who are generally local, not even regional, who are because people prized being local. And the truth is you need to be local in one way or another in order to source good deals nowadays. But the small local guys are just not that sophisticated, and they don't have a global platform, and you have to be global to sell. The big guys, the Carlyle, to your example, they try to impose the big model on small markets. Carlyle put together, $700 million for Africa, and they put together a team that had never been together before, and it didn't work. And so there we are, right? The big guys don't know EM, and the small guys aren't big enough. And this middle tier of sophisticated, mid-sized EM private investing firms isn't there yet. So I think you have a very young industry and very fragmented, and this is why the returns haven't been there in emerging market private equity writ large, and the dispersion is enormous between top performers and less good performers. On the liquid market side, I don't think it's returns, it's risks. It's the volatility of EM equities in particular, again, writ large, is just makes it a market timing asset class. And that makes it tough.
I have a colleague, friend at work, who took his mother's savings, and I won't say which company, but a Brazilian meat packer bought an 8% a year dollar bond, and she's sitting on that to maturity. Isn't that, surely that's it's easy. You get a huge rate of return. You don't even need to worry about whether the company's going to grow or not. You just have to make sure it doesn't go bust. So
is it a dollar?
It's a dollar. It's a dollar bond, yeah.
Well, the Brazilian meat packers have. I would suggest that he study the Brazilian meat packers.
Yeah, I would say that's pretty insane.
It's going to make him nervous.
I've had some ups and downs over there.
I think it's insane, but the returns are there. So no, I think he's nuts.
So that's
but,
the
so
promised
far, so
return.
good.
That's the
Yeah.
coupon
Yeah.
that you're referring to. So there's.
He hates his mother. That's
He just violated every rule of investing.
Yeah. It's all in one place.
So diversification is an important one. Actually, there's been a role for Brazilian meat packers in our portfolios over the years. There have been certain ones, Minerva, for example, that we've liked at certain points. You do need to follow these companies very, very actively, and I think that. There are times when, and I think that when it comes to idiosyncratic bottom-up credit, which is really what we specialize in, the important thing is to recognize the mean reverting situations from the ones that are going to spiral down, and certain factors that are outside your control that can cause that spiral. So if you remember telecommunications in the early 2000s, that was an example of an entire industry whose entire stock became close to worthless, right, in a relatively short period of time. So that kind of overcapacity can affect an entire industry and can take you down completely. If you throw in emerging markets risk on top of that, so country risk, that gives you a second dimension. And if you'd said it was local paper, I would have said the currency is a third one. We've talked about repatriation and expropriation risks. Emerging markets are nothing if not a bundle of risks.
Yeah.
So risk management, managing sizes, diversifying, and actually making sure that your portfolio is impervious to, let's say, the Brazilian meat packing industry going kaput over the next 2 years, which, I don't think is going to happen now, but it's happened in the past. And so I think that, you have to be impervious to those because you cannot have the visibility to see all of the circumstances that could lead to that. And those risks are always 1%, 2%, 3%. So you always have those risks. Some of those things will go against you. And that's why I think in addition to the credit selection component, you need the risk management component. Make sure you never get too big in any one of those.
I just want to add one word on risk. I think there is a misconception on risk and how you build a portfolio. If you're investing in a portfolio of companies which are non-cyclical by nature, and we're talking again about these structural gaps, typically these are less volatile and less influenced by short-term flows and short-term events. So already you own a portfolio which is typically less volatile. And when you think of the smaller emerging markets or the frontier market, typically, again, they have idiosyncratic stories that are unique to them, and they're driven by domestic events and domestic macro policies, etc. And if you look at the correlation as well between these different markets, it's extremely low. So if you think what drives Nigeria versus Pakistan and Vietnam or Argentina, it's completely different drivers. So we actually end up with a portfolio with a very low volatility. Our fund in particular, and most actually frontier markets, have not realized the volatility much higher than the S&P. It's actually very close to it, just by the virtue of diversification within the frontier space. Every single country, of course, nobody would say the opposite, is higher risk than a developed market, but together as a portfolio, it's not. And if you add to that the fact that you are staying away from cyclical businesses which are driven by global demand and export businesses which are typically not of interest to us, you end up with a portfolio which is quite resilient to the downside.
There is a big sign in front of me saying we have to finish for the plenary. I would just like to say though quickly, or just my little 2 cents for your question. When emerging markets have their own investor base, that will be much more healthy because that money will not run away in times of stress. And until then, they are at the mercy of other forces. Anyway, thank you all, panelists, audience, very lively session. Thank you very much.